Vanguard, Vanguard, Vanguard. Everybody's talking about Vanguard and why you should get your own account. But today, I'm going to talk about why you might not want to go with Vanguard. So welcome back to the Transparent channel where I share my whole money journey. Everything from my ups and my downs and everything in between. And where I track my progress to hitting £1 million in my ISA account. Now in today's video, I wanted to talk about Vanguard. Now I know this is probably not going to be a popular topic and I'm going to get some hate and it's going to cause a lot of controversy. But I don't think that Vanguard is always the best way to go. Now I'm fairly new to YouTube in the finance space, and I'm actually really surprised by the amount of people who are recommending Vanguard as an option. But I'm not new to investing, and while we're at it, I'm going to show you where I'm up to in my portfolio. So let me just check and I'll pull it up for you guys now. So my portfolio as of today is currently standing at, and I'll put it up on the screen now, so I'm currently standing at £107,944. And that's not to show off, it's just to show you guys that actually I've been investing for a while, I've got some knowledge and give you some background. It's a personal hate of mine when you kind of see people giving this advice but they're not showing you the figures or sums or where they're actually up to. Hopefully by making this video I show you guys where I'm at, what I'm doing, and it'll give you some background on me. Now I've traded for a while and I've used lots of different platforms, and I'm actually surprised by how many people on YouTube are all recommending Vanguard. And they're doing the Vanguard portfolio updates, their Vanguard account, how to start Vanguard, and they show you all these different accounts of where they're up to. But actually it doesn't really amount to much. And I start to wonder, are they just doing it for the content because Vanguard's a good keyword, they make a good keyword, they get more views and so on. And the problem is with a lot of these is that they have a lot of Vanguard funds. And you start wondering, why have they got so many different Vanguard funds in their account? Why do they need 20 or 30 different funds in such a small portfolio? My portfolio currently has about 5 shares, which might sound absolutely crazy to some people that I'm not spreading my risk and I'm not doing this. But actually, depending on how much you're wanting to risk and the balance of your portfolio, you don't need to have that much spread. But I can understand in a way why for a new person Vanguard could be an option because it is quite low risk. If you go in and you buy 20 different funds, you are spreading your risk, but I don't think that's a really great way to invest. Really, you need to decide which investment strategy is right for you. And I think there's 3 ways you can go, A, B, and C. And let me kind of give you those and break them down for you. So option A is to go for something like Vanguard, ETFs, and play it really, really safe. And I think this is where the big disparity comes on YouTube. So you have some people saying to go for Vanguard, buy 20 different funds, and a fund basically splits your money between different investments. For example, you can buy a Vanguard ETF of the top 100 FTSE companies and that will spread your risk over the top 100 companies and how they perform. Or you can go for the top 250 companies in the UK and it will spread your risk across them. So that's a great safe option for 95% of people, as Warren Buffett, one of the most successful investors in the world, says. 95% of people should just get an S&P 500 or in our case a FTSE 100 or FTSE 250. Top 250 companies is different ones you can go for and then spread your risk and slowly add to it. Over the years you'll achieve your 5 to 8%. I took an average of 7.75%, which was the average of the FTSE 100 in my last video where I talked about my strategy to hit £1 million in an ISA account, and I based all of my calculations on that. So that's option A. You spread your risk over a load of different companies, you slowly add it up and add and add and add, which can work out great, but you don't want to go over too many funds. So where these people on YouTube have got maybe 20 or 30 different funds, they're basically just adding funds to make content for a video so they can talk about 20 or 30 different funds and show you how great it is being in all the different funds, what each fund's doing, when really it doesn't really mean that much to you. So for example, if we look at it on just a really basic level, this isn't really accurate, but it's just a rough idea. So if you had £1,000 that you wanted to invest, if you put that in the FTSE 100, you're essentially splitting your risk between 100 different companies and getting an average of their returns. So you're basically putting £10 in each company. Now if you went for a FTSE 250, for example, you're then putting maybe £4 in each company. So you're decreasing your risk even more. Now for example, a lot of funds cover maybe 100 different companies. If you go for maybe 10 different funds in 100 different companies, you're then in 1,000 different companies with £1,000, you're literally putting £1 on every company, which in my opinion is so low risk and such spread out. But the problem is with low risk, you could end up with really low rewards. It's all about risk and reward and how much you want to risk and how much you're looking to get back. Option B is the other thing you see on YouTube, which really drives me insane. Everybody recommends shares that are just hyped. So they're telling you to buy Apple, Tesla, Facebook, all of these crazy shares that are hyped up in price, or GameStop, and they're saying this is how you're going to get super rich super quick, and it's just a disaster. You'll start buying and selling shares, you'll end up losing money overall, when actually you would have ended up with much more if you just would have gone for a fund in the first place, which is what I learned the hard way. I tried to do it myself back in the past, and I didn't really have fundamentals for buying the company. I was just buying it because I liked the company, or people were sharing it, and it seemed like a really cool option. It was cool to own Netflix shares, it was cool to own Tesla shares, but actually you don't want to buy shares based on just because it's cool, or you like the cars, or you like the watches. You know, it's not really a solid way to buy shares. So option C, which is a much safer option, is having a bit of both. So why don't you have your fund with maybe 75% of your portfolio and then 25% of your portfolio? Why don't you look to buy your own shares? So why don't you do solid research, buy the shares, invest in them and hold them long term and wait till they come up? And that for me is what's worked out to work really well. I was in these funds and it worked quite well, but the return is quite slow. So it depends how much return you're looking to get based on your investment. So for me, like I said, I've had Vanguard funds in the past. I was quite surprised because I've always known as a Vanguard as being an investment firm, but I was quite surprised how they were saying to open your account with Vanguard directly. Now I think that's quite a silly option because it pushes you to invest in just Vanguard funds. And what I want to do is, just for example, is show you, I've got my Hargreaves Lansdown account here, and I've also got my Freetrade. So I'm just quickly going to show you. So I've gone to my Hargreaves account, so I can just do a quick search for Vanguard, and in here you can see you've got the shares, you've got the funds, and if you just look here, you can see pretty much all of the Vanguard funds are available to trade. You've got your equities, you've got your stock index, and actually for you guys, if you're just starting out, all you're going to want is a FTSE 100, and you've got an option with accumulation and income. So accumulation basically means if you get profits, it will invest it back in. So you get dividends from the companies within it, it just invests it again and again and again, and it builds up. If you want income, it just pays it out directly to you, but you're not going to be looking at that unless you're at a late stage like retirement where you're looking to take the dividends as income. So you've got plenty of them in here. So there's so many to choose from, which is actually really, really confusing. So if you get looking at a lot of funds, there's also absolutely endless possibilities. Do you really know what Japan's stock index is? We've got life strategies. What's the difference between all the different life strategies? There's so many funds. And what I'll do is I will go over some of the most popular funds in a later video. So if you're interested, make sure you subscribe for that. And I'm also just going to quickly show you my Freetrade account. So it's the same thing exactly again in Freetrade. So if I go into Freetrade and I do a quick search and we search for Vanguard. If you search the same for Vanguard, you can see you've got all of the funds pretty much here. There might be a couple that aren't within here, but I mean, why do you need to limit yourself to Vanguard? Okay, I think you can buy some stocks and shares through Vanguard, but why limit yourself as a beginner? And I think as well, because I'm really passionate about investing, I think actually having the ability to buy individual shares, do your research, hold it, even if you just maybe put £100 into a particular share, investing in that with your reasons and knowing why it was a good buy, it's so good to see that come up over time, and then you can think, wow, that really paid off, that was awesome. So in a standard account like your Freetrade, you're going to be able to hold individual shares and hold funds, so you can have a mix of both and you can really learn the basics of investing. The other thing to think about with funds is if you're getting an average rate of all these companies, it's great, but you're going to get much lower returns. So my goal has been, although it's great to get that 7.75%, I really want to beat the stock market. So I want to beat the FTSE, I want to beat the S&P, so that's my overall goal as an investor. So for example, if I was to have invested in those funds last year, I would have made much less than I would buying individual shares. So I'm just going to read off a couple of examples here. I'll break down my full portfolio in more detail later, why I bought it and how it happened, so make sure you subscribe for that, that'll be coming soon. So just look at a couple of my buys last year. So I've got Aviva. Last year I made 52%, I made £10,000 on Aviva. I've got Taylor Wimpey, I've made £8,000 on, another 50%. And there was also a few other companies. I had BP, I made about 50% on that one. And I also bought Disney, which were a really good buy at the time, and I had solid reasons for buying. So for example, with everything locked down, they had Disney Plus, and I thought that was going to help carry them through the lockdown. So I invested in Disney. I think I made about 15% on that one. So just to show you guys, so for example, if you saw my video on silver that I made last week, I invested £20,000 in Heckler, and I've made 17% return so far in a week. So just to show you guys, you can make really solid returns when you get it right. Okay, you don't always get it right, but it's quite nice to buy individual shares and hold them long term. You can actually make much more money by buying individual companies than just buying 20 different funds. What I'm going to do in later videos is break down my whole portfolio, give you some solid share buys. What I'm going to do is break down which funds I think you should be investing in on which platforms. And I'm thinking later this week I'll actually do a complete tier list on ISAs and show you which ones are the best to buy. So rather than go for a Vanguard account, what I would suggest for a beginner is to go for something like Freetrade. It's so easy to use and there's no fees. With Vanguard, you're also going to get a 0.15% charge on your account, and in Freetrade you're not going to pay that. And like I've shown you can buy Vanguard funds within Freetrade, so it's nice and simple. If you haven't already got an account, you can sign up with a link below and you get a free share when you make your account. So I hope you guys found this interesting and it wasn't too much of a rant, because I like to share really transparent, honest advice and share my feelings, whether it goes against what everybody else is promoting. My initial thoughts was everybody must have an affiliate program and they're making so much money that they're all pushing Vanguard. But actually it's not that. I think people just don't really have a full understanding of the market, don't really know how to properly research a company and what you should be buying, what you should be selling, which I don't think is their fault. They're just trying to share general advice that will help you. But what I want to do is kind of put something against that and argue against that and say where should you be going, what should you be buying, that will hopefully give you guys some transparent information on your shared journey. I know the deadline's coming up, so make sure you get your ISA balance topped up and get your account opened. And if you can hit that like button, it'll help me out and help grow the channel and get more people seeing this video. So thank you guys so much, and I'll see you in the next video.